All right, good morning, everyone. So today we're going to do a few things. Obviously, I want to show you the software, the Trade Scalper, the Atlas line in action. I want to help answer your questions. I want to take a look at the market as a whole. We're going to look at a few things. So just one moment here. All right, very good. All right, so the first thing we have here on the chart you see is one of the indicators, one of the software called the Trade Scalper. The idea behind the Trade Scalper is to produce these signals based on price and time. There is nothing linked to it like a moving average or an MACD or stochastics or any type of indicator whatsoever. So the good thing about this type of trading is that we're focusing on just the price and the time. The course explains how the method works and is calculated, but we're just looking at price action and telling us what to do. Okay. Now this is a universal idea of trading the mini or the euro or the crude oil as an example. And so for example, if I switched here, I haven't looked at the crude oil this morning, but if we looked at the crude oil, you're going to see similar signals here on the crude oil, and there's nothing to do with optimization for one market and compared to another. So again, it's working on both price and time, helping us understand whether we should buy or we should sell the market. Now, I like to use the ATM strategy, which allows on NinjaTrader, you don't have to use it, but I like to use it because it automates the signals to exit the market on a stop or on a target that you predetermine. So the good thing about using that type of automation is that when the market is very fast, your targets are hit very quickly and you have your stop in place to protect you. You can place the orders manually to exit the trade, but you always have to enter the market based on the rules and based on the signals that you see here. So this is the crude oil. We go back to the E-mini. Now, when the market is volatile, as we've seen yesterday, due to the virus that's happening here, typically we have to be careful when we trade because the market could move very fast. Okay, so when I look at the market moving very, very fast, I prefer to identify the best opportunities when the market is very fast and take a larger target, because when the market is slow, you're going to have a slower or it takes much longer for the profit targets to be made. So when the market is volatile, it's not that it's a great thing. We have more risk, but we also have this opportunity to extend a profit for not just 4 ticks, maybe 8 ticks. Now, the way that I like to look at this idea of whether the market is slow or whether the market is fast, we can see the candles as they're moving, right? They're moving at a good clip here. And you can ask questions, by the way. This is an interactive session. So if anyone does have any questions, please go ahead and type them in the chat box there. This is not a pre-recorded presentation. This is a live presentation. So I invite you guys, if you do have any questions, to please go ahead and ask the questions there so I can help answer them. So what we have here is the 5-minute chart. I have the Atlas line here in the chart. This happens to be yesterday, and we'll take a look at today as well. But you're going to see here on the bottom part of the chart here, this little squiggly line. This is the ATR, the average true range. I have a lot of videos on using the ATR. I teach this as well in the courses and in mentorship, that the ATR, the average true range, is a great determiner to tell me whether or not the market is slow or it's fast, right? Yes, Sally, there is sound, Sally. So if you do not have sound, I would recommend, obviously I have to type it for her, but if she has, oh, you good? Okay, good. All right, good. Yeah, there's, this Adobe program has a couple of settings there for sound, so you may have to play with it a little bit to get the sound going to turn it on. So what we're looking at here is the ATR, the average true range. So what I teach in the mentorship class and in the courses, whatever you're doing as far as trading, look at this idea that the market is relative to its current conditions. Okay, you can't trade the same way when the market is slow. You can't trade the same way when the market is fast. So if you look at currently right now, where we are currently um, on the 5 minute chart live, you can see that the ATR is about 5.75, almost 6 points. So that would be considered pretty volatile. This would be a little bit of a concern if you're going to trade, because I know that from wherever the market happens to be, when this candle closes, it could go up or down this amount, which is almost 6 points. So you have to think about really what that means. It means that if the market is moving at about 6 points high to low, each candle moving forward in time, our stop, if we're trading a 5 minute chart, our stop, in order to stay in the trade, has to be at least equal, if not larger, than the current conditions, because it could easily move up or down 6 points. So if you have a 1 point stop on every single trade that you take, regardless if the conditions are slow or if they're fast, it could very easily just take you out of the market. So for the new traders here, I know I see some new traders here in the room that are saying, okay, what is the ATR and what is this all about? Think about when the market is slow, the conditions that exist as a trader under those slower conditions, and think about the opposite side when the market is very volatile, those conditions that exist. If you take a look at this high and this low here, you see how large the movement on 5 minutes happens to be. The movement from here to here so far, from here to here, is 11 points. So if I have a stop that's 1 point or 2 points and I'm going long or I'm going short, this idea that I'm able to hold on to a trade as it fluctuates up and down and up and down, it's a problem because you can easily get taken out. So this is this concept that I try to drill into every trader, that you can't trade the same way when the market is slow in comparison to the market is fast. The concepts are different. More volatile markets trend, slower markets whipsaw. So if you ever see a slow day or you see an overnight after hours situation, typically the market is very tight. It's just chopping along, it's not doing anything, hours on end, and it's not going anywhere. And so you have to be prepared and trade for those conditions. The opposite is true when the market is more volatile. You have to expect different situations. So this is something that I try to teach everyone. The next class is February 27th. All right, Mike? So if you got it. All right, Mike Thomas, for the next class is starting Thursday, February 27th. All right, Raul, 12 to 1. 12 starts at 12 o'clock to 1 o'clock, twice a week. And everything is included, right? All the courses. The Atlas line is lifetime. The Trade Scalper is lifetime. That's correct. All right, so as we're waiting for here the Atlas line to appear, usually it appears probably about 5 or 10 minutes. I want to be able to get out of this chaotic situation. 7 points, you can see here, that's a huge, huge number. Every candle on average, right, takes the last 4 bars, is moving at 7 points. So how can we mitigate this, or how can we trade under these conditions? Well, if you are using a 5 minute chart, then I would recommend dropping it down to a smaller time frame. If we drop it down to a smaller time frame, this ATR and the conditions, we still use the same rules, we still use the same stops, we still use the same targets, but we're limiting the amount of risk because we're using a smaller time frame. These candles are smaller, or they should be smaller. So if I look at, for example, a 2 minute chart here, you see the ATR is not 7 but 5. It's still large. It's still a big number moving up and down, but this is one of the ways that you could still trade instead of using the 30-minute chart or 60-minute chart, which has these big numbers. You can trail a stop, you can hold on to a trade with using a smaller time frame. Okay, so we have the Atlas line here, we have the Trade Scalper here. Something else I want to discuss is the cycles that exist in the market. If you look at day in and day out, you can say every day is different. But when we look at the, you like tick charts, Dana? 1600 tick chart, okay? I can look at that as well, 1600 tick chart. But when you look at the cycles that exist, typically we have these cycles that you can use as a forecast and as an indicator, right? A forecast is an indicator to tell us where and what could potentially occur. So a forecast would be, well, today was volatile. Tomorrow we can have 2 or 3 days of continual volatility. Or today was slow and we can have continual volatility of the market being slow. So whenever you see a day that is volatile or the ATR, we're looking here at the ATR here, is high, very high, immediately everyone should expect the next few days to be more of the same until the cycle changes and gets back to normal. Or if you see 3 or 4 days of the market being very slow and being very choppy and being tight and everything getting stopped out because it's a big whipsaw, expect a few days, 3 or 4 days of the same conditions, that same choppiness. Typically, the cycle is 3 to 4 days. If you look at the market yesterday, it started to become volatile. I immediately thought to myself, we're going to have a few days of this volatility until things get back to normal. And what it does is it shakes a lot of these traders out of the market and things get back to normal. Okay, so I have the Trade Scalper here on the left. I'm sorry, on the right, I have the Atlas line here on the left. And what I'm going to do here, I think would be better if I just move this so we don't lose the charts, something like this, so we can see them better as they occur. Now, I want to show you the diversity of these methods. Dana recommends a tick chart. I can show you a 1600 tick chart. If anyone wants to look at, for example, a second chart is another way of trading where you look at, instead of a minute, instead of a range chart, especially for scalping, we can look at seconds. Now, I recommend the 10-second chart if you're going to scalp. So again, if I put on the 10-second chart, every candle is referencing 10 seconds. The signals will be fairly close as far as when you go between a 2 range chart and a 10-second chart. They're a little different because they're calculated differently on the 10-second or 2 range, but they're going to be very similar in where they occur, the pricing. Remember, this is based off of price and time. So this is where we're at right now on the 10-second chart, and I'll go back to a range chart here. Okay, so we have here a short at 32.2675 here on the range chart for the scalping. So this is how this is going to work. You place an entry for 32.2675. The market, and I remember, I think it's very important not to chase it, where if it runs away and you're not filled, this is not where I want to be filled short. I'd rather be filled within a tick or two of where the signal occurs. So you could do one of two things. You can enter right at market, so click the market button. You can place a market if touched at 32.2675. You can also use a limit order. But what I would not do is at this point, as it's moved, how much distance has it moved? Here, roughly 4 points. This is not where you want to be as a trader. You don't want to enter 4 points after the signal has occurred. Okay, so this is something that we have to be careful with, not to chase this market. It's still very volatile, 5 points. It's expected, this volatility that you see here. If you did not get the trade, we have so many trades to take that it's not worth jumping in at a bad fill at a bad price. So please just wait and be patient. If whatever the reason, and I know a lot of people have the Trade Scalper software and they're taking the same trades as I am. So if you miss the trade, leave it alone. There's plenty of opportunities. You have tons and tons of opportunities to take trades. What's important is to keep your stop and to keep your target. Jason says here, do you still only use a 3 to 4 tick volatility day for scalping on the when the ATR is high? So the question, Jason, is whether or not we keep the same targets and stops, and the answer is no, not especially not if the market is this volatile. A little bit more opportunity to take and trail this as well when the market's this volatile. So the market is slow, 3 ticks, even 2 ticks. You know, we're seeing these volatile conditions, but when the market is slow, it's really not necessary to hold off an hour until the market makes 4 or 5 ticks. It's only going to be a 2-tick target under those slower conditions. But this, what we're seeing right here, your target should be much larger. You can trail a stop. I've shown a few videos and explanations on how to trail a stop the way that I like to do it with multiples of 2, 4, 6. So you can definitely take a larger profit, Jason. Joe says here, is it possible to, a second, Joe, make sure I send this to everybody. Is it possible to automate the trade scalper in such a way that we just need to click on it on the screen to enter into the trade? Yes. So if